The number on your screen is $500. It feels like a lot. It isn't. You downloaded the app at 11:30 on a Tuesday night because someone in a Reddit thread said they turned $2,000 into $14,000 in 3 weeks. You don't know what a PE ratio is. You don't know what a market cap is. You know the name of the stock. That's enough, you think. You buy 11 shares. You watch the price refresh. Every 4 minutes it goes up 3%. You feel like you've discovered something. It goes down 9% the next morning. You don't sell. You don't know why you don't sell. It keeps going down. You tell yourself it will come back. Some things come back. This one doesn't. You lose $190 in 6 weeks. You close the app. You don't delete it. You reopen it 3 months later with a different question. Not which stock, why stocks. You find a video, then another, then a book. You learn about index funds for the first time. And something clicks with a quietness that surprises you. No picking, no predicting, just the market, compounding time. You open a brokerage account, a real one. You set up an automatic transfer of $200 a month into an S&P 500 ETF. You read about compound interest and run the numbers yourself. If you do this for 30 years at a 10% average return, the math becomes something you have to read twice. You don't feel excited. You feel something steadier than excited. The boring feeling is the point. You stay the course. Most people don't. You do. That matters more than you know yet. But the staying feels slow. You start reading more. Not articles, filings. You find a company you think is undervalued. You read the 10K for the first time and feel the unfamiliar weight of actual information. Revenue, margins, debt structure, footnotes. You build a watch list. Then you build a second one. You have 12 positions now. You've read 4 books. You think you see patterns other people miss. You think the market hasn't priced this one correctly. You tell a friend about a semiconductor company and why it's trading at a 30% discount to intrinsic value. Your friend doesn't know what intrinsic value means. That gap makes you feel something. You're not sure if it's arrogance or clarity. You haven't found an edge. You found the beginning of a framework. Those are different things. You'll understand that later. You discover charts, not the fundamental kind, the visual kind. Candlesticks, moving averages, support and resistance levels. You find a community online where people share setups and entries and exits. You learn what RSI means. You learn what MACD means. You buy a second monitor. You quit the index funds because they feel like surrender. You make $800 in a morning on a biotech catalyst and your hands are shaking in a way that has nothing to do with fear. You make $2,200 the following week. You are convinced you have found it. 2 months later, you are down $11,000 on the year. You don't call it losing, you call it tuition. That reframing is how you survive. It is also how you avoid the lesson. The charts are not lying to you, but they are not telling you what you think they're telling you. Your emotional state tracks your profit and loss with disturbing precision. On red days, everything feels wrong. On green days, you feel chosen. Neither state is reliable. Neither state is investing. Someone mentions options in a forum and 3 weeks later, you are fluent in a language you didn't speak before. Delta, gamma, theta decay, implied volatility. You understand that options aren't just bets, they are structures. They are leverage with geometry. You put $6,000 into call options on a stock the day before earnings. The stock moves the wrong direction. Your $6,000 becomes $340 in 48 hours. You sit with that for a long moment. You rebuild. You study the Greeks with the focus of someone who has recently been shown what the floor looks like. You make 40% in a single month on a volatility play you'd been watching for 6 weeks. You feel architectural. You give it all back in 8 days when the trade that was supposed to be a hedge becomes the loss. You are still here. That's what separates you from the people who aren't. Not skill, not yet. Survival. A willingness to keep going after the account resets to zero. Then something shifts, not the portfolio. You stop watching the screen every 4 minutes. You read The Intelligent Investor and underline the same passages 3 times.
You read Poor Charlie's Almanac and sit still aftermard in a way you haven't in years.
You read every Buffett shareholder letter going back to 1965 and begin to understand that what sounds like simplicity is actually the output of extraordinary depth. You restructure everything. 8 positions, companies you understand completely, businesses with durable advantages and honest management. You hold through a 22% drawdown without selling and feel for the first time like you actually believe what you believe. You stop watching CNBC not as a discipline, as a natural consequence of no longer finding it relevant. The people you know want to talk about what the Fed will do next quarter. You want to talk about what a company will look like in 12 years. Someone asks if you'd manage their money, then someone else does. You think about it for a long time before you say yes. You file the paperwork. You launch with 40 limited partners and $28 million in assets under management. The first day you sit with other people's capital, something recalibrates inside you. It is not fear exactly. It is a new weight that doesn't leave when you close the laptop. One bad year and this ends. The relationships, the trust, you invest accordingly, not more cautiously, more honestly. A year later, you are that person. You oversee $4 billion. You don't pick stocks anymore. You allocate to managers. You evaluate process, not just results. The machine doesn't care which one you choose. It keeps running either way. That filter removes a surprising number of ideas. Your best year is 31%. Your limited partners are satisfied. Satisfaction in this business means they stay. You stay, you grow. You are sitting across a conference table from the CIO of a university endowment. And he is asking you to walk him through your process. You do. A year later, you are that person. You oversee $4 billion. You don't pick stocks anymore. You allocate to managers. You evaluate process, not just results. What impresses you is a person who has a clear and honest theory of why they have an edge and can articulate exactly when that edge would fail. You think in decades now, not quarters, not years, decades. Inflation cycles, demographic curves, geopolitical realignment. There is one man who bought 500 shares of Coca-Cola in 1988 and still holds them. He lives in Omaha, Nebraska. His office has no computer. His desk has newspapers. He reads 500 pages a day. He has for 60 years. He doesn't trade. He owns. There is a difference so profound it can take a decade to fully feel it. The game looks different at every level. At the bottom, it looks like money, fast money. Obvious money, the kind that arrives in other people's social media posts. At the middle levels, it looks like information. Whoever knows more wins. That is closer to true, but still incomplete. At the higher levels, it stops looking like the market entirely and starts looking like something closer to philosophy. What do you actually understand? What do you do when the price says you're wrong? And the business says you're right? The ones who last the longest are not the ones who traded the most, who found a level of honesty with themselves that most people spend their entire lives avoiding. Somewhere right now, someone is staring at a $500 account on a phone screen.
There is one man who bought 500 shares of Coca-Cola in 1988.
Purchased in 1958 for $31,500. His office has no computer. His desk has newspapers. He reads 500 pages a day. He does not attend many meetings. He does not take many calls. He makes decisions the way a geologist reads rock formations. Through accumulated depth, not urgency. His portfolio has outperformed the S&P 500 for 6 consecutive decades. He has given away more than $50 billion and signed a pledge to give away 99% of what remains. He doesn't trade, he owns. There is a difference so profound it can take a decade to fully feel it. He is not trying to win. He stopped needing to prove something so long ago that the memory of needing to prove it has faded entirely. He wakes up and does this because it is what he is, not what he does. What is your real edge? What are you willing to hold? When holding feels irrational and seems reachable if you can just find the right ticker, it is not that. They are not the ones who found the best setup. or caught the biggest move, or blew up the fewest accounts. They are the ones who eventually understood what they were actually doing and why. Who stopped asking what the market was going to do and started asking what kind of investor they were capable of being. He is not trying to win. He stopped needing to prove something. He means it without performance. That is perhaps the most remarkable thing. The game looks different at every level. He doesn't trade, he owns. There is a difference so profound it can take a decade to fully feel it. You stop confusing activity with performance. You would have previously acted on,